Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast, where we talk all things money and business. My name is Christian Allen, and with me, as always, my co-host, Rod the Pod Zabriskie. What's up, man?
Glad to be here, as always. I think we have a good one today.
We do. I think we have a really good one. Okay, so we did something a little bit different, Rod. This is kind of like a niche episode in the sense that we had a really focused topic. So we talked to AJ Shekar, director of Provident Healthcare Partners, and our conversation focused on private equity in the healthcare space. Yep. So naturally, it made sense to have an expert in that space. But in addition to AJ, we also brought on a guest host, Dave Ferguson, who is a client and partner of ours. He owns 17 dental practices. So he's been really successful in that space. And because of our previous conversations with him, we know that he's been intimately familiar with this concept idea, with what's happening in that space, because he's been approached by potential private equity partners. So anyway, we thought it would be really cool to let the two of them play off each other a little bit. And I thought they did a nice job of it. Absolutely. So Rod, why don't you give us just a little bit of an overview of who Dave is, and who AJ is, and then we'll launch into the interview.
Yeah, absolutely. So Dave is, like you said, orthodontist based out of San Antonio, Texas, and part owner in 17 different practices across 5 different states. I think he's been a catalyst in really helping a lot of different dentists out there get up and going and really into a really cool model. So that's a story in and of itself. But absolutely. He
also has a model where he's teaching dentists how to do what he's done.
Yep.
And so he's doing just a whole bunch of really cool stuff from that standpoint.
Absolutely. So again, great to have Dave on as kind of a guest host, and for him to be able to see it from the owner side of what does this mean, to practicing, in this case, dentist, but it could be any healthcare professional.
Yep, I thought that was really valuable.
Cool. Okay, and then AJ Shekar. So he is a director at the Provident Healthcare Partners, where they go in and look at opportunities to purchase either all or a portion of a practice. They do some consolidating of practices into kind of groups within the kind of private equity format. And again, we'll get into more detail on the different ways that they do that, but that's ultimately his focus is kind of helping to do that.
Yep, and he did a nice job of answering a bunch of questions, right? We asked questions like, why would somebody consider doing it? How do you value businesses? What does the structure look like? Timing. So we got into a bunch of different questions, and I thought he had some really great insights across the board. And like you said, it was nice to have Dave asking some more pointed questions that we probably wouldn't have thought of.
Absolutely.
So anyway, really great interview. We enjoyed it. Hope you guys enjoy it. Okay, we are very excited to have with us AJ Shekar, director of Provident Healthcare Partners. And AJ, I've spent the last couple of days trying to get as much info about you as possible, and it sounds like you guys have a pretty cool thing going at Provident Healthcare Partners. Before we jump into that, though, I want to make sure that we get a little bit of your background, how you got to where you are, and maybe, something you like to do when you're not transacting private equity deals.
Absolutely. It's great to be on the podcast. Really appreciate the opportunity to participate, and happy to give kind of a quick background on myself anyway. So I grew up in a kind of medically oriented family. My mother was a hospitalist physician, had some other family members who were in healthcare. So there's always kind of the push to go the healthcare route. But what happened in my undergrad days is that I got to, I think it was either physics 2 or organic chemistry 2. I can't remember what it was, through my pre-med schooling, and decided I couldn't do the hard sciences anymore. I had a preference for the business side of healthcare. So credit to Dave and all of his colleagues who were able to get through all those years of schooling.
Smarter than the rest of us.
Definitely smarter than the rest of us, and a long, hard road to get there. But I spent a lot of time in economics, accounting in undergrad, and found a nice crossover at Provident where we advise healthcare service companies and provider-based groups that are thinking about strategic alternatives, whether that be private equity in nature or merging with a larger strategic player. We've seen a lot of businesses that have been successful, what the drivers of their success were at the same time, and how that meshes with the overall market. So that kind of aligned nicely with my kind of interest in healthcare to start, as well as my kind of finance accounting type background. When I'm not doing transactions, I love hanging out with my 6-month-old Labradoodle. He's a lot of fun and cool. A lot of energy there. But my wife and I live in the Minneapolis, St. Paul area. So we like to get outside as much as we can, whether that be, doing travel when we can, hiking, playing golf, playing tennis. So nice. I'd say when we get time, that's where we spend our leisure time anyway.
Okay, so when I think of Minneapolis, though, I think it's 27 degrees where I'm at. What's the weather like in Minneapolis right now? Are you playing a lot of tennis?
Only indoors.
Yeah, that makes sense. Okay.
Yeah. Sometimes you play like platform tennis outside, which you could still play in like 0 to 10 degree weather for the ones that really like that. But lots of indoor activities these days.
Yeah, that makes more sense. Yeah. Okay, cool. Well, thanks for kind of giving us a little bit of your background, and I'm excited to jump into this conversation about what Provident does as a whole. And I'm thinking like it would probably be helpful for listeners to just give some context as to what Provident is all about, and kind of what we're going to be talking about. So maybe set the stage for our conversation about private equity, kind of moving into the medical space.
Absolutely. The quick synopsis on Provident is we are, I guess by the definition, a healthcare investment bank. And what that means is we advise companies that are in healthcare services that are at kind of an inflection point in their growth trajectory where there's different motivations from the shareholders and from the managers of the company to either take some chips off the table in terms of cashing a portion of equity out of the business, bringing in resources for further growth, diversifying their overall risk within kind of their holding, or considering where the advantages of their business are with respect to their peers, and taking on much more of an aggressive growth strategy that requires outside resources at the end of the day. And so a lot of our clients are founder-owned and operated businesses. So a lot of times they started that business without necessarily the idea of an exit in mind. And when they consider a transaction, it's their first time going through this. And so as a firm, we seek to be educational resources, regardless of whether or not we kind of work with those companies through a transaction around, what's happening in the market, why are deals going on, how can people who are considering a transaction be best prepared for that event when it ultimately happens. And certainly for those groups that we engage with, just really helping them craft, a transaction process that meets their goals and objectives, but doing so in a way that is, maximizing the outcome for the seller side of the deal. So as a firm, we're a sell-side focused investment bank, meaning our allegiance is to maximize that outcome for shareholders that are selling equity in the business. We certainly have a number of different relationships with PE sponsors and strategic players that ultimately will be good partners for our clients. And we kind of help sift that buyer universe to, something that's more manageable and, appropriate for each client that we take on. But at the end of the day, we're providing kind of soup to nuts advisory services where for the groups that are just thinking about what a deal could look like, helping educate them on what a transaction could mean for them. and certainly for the groups that we work with, essentially, staging a competitive process where the goal is to maximize value and create the best outcome possible in an efficient time frame. So that's kind of the 30,000 foot view. Lots of different nuances that go into that, but that's kind of us in a nutshell. And just given the types of groups we work with that haven't been through this before, this is the first transaction they may go through, perhaps even the last transaction that happens in their careers. We understand that it's kind of a formative event in their business careers. And we take that, to heart in terms of providing, the education, the resources to make that happen.
Okay. So I want to switch gears a little bit. And Dave, I want to get the perspective of the other side of it. So we have AJ here on the business side of getting deals done. And then we have Dave over here who owns the offices and is someone that might be considering doing this type of thing. But maybe, Dave, from your perspective, can you just give us like a high level overview of kind of what you're seeing in this space in the marketplace? And just again, I just want to get a different feel for it. So kind of just talk about what you're seeing out there.
Yeah. Thanks for having me on the podcast. AJ, it's great to have you. Excuse me. What's interesting to me, AJ, as you talk, as owner operators, at least in healthcare, once you get a few offices, it seems like there's a couple investment banks or advisors or brokers that will start to call and ask questions. They're probing, hey, are you interested in some type of transaction? What's been interesting and fun, yet I haven't quite figured out how do owner operators learn to discern between different investment banks? Really what happens is most of us will get into touch with them almost from a cold call. I mean, that's what it seems that, they'll call, they say, hey, are you interested? They'll start talking about some terms that I think a lot of people don't necessarily understand when they first hear them, EBITDA and other things that we'll probably talk about. But I guess, for the listeners, for those people that do eventually get there, what is a process and how does an owner operator go about finding and discerning, hey, who are the right investment bankers to work with?
Yeah, that's a great question. And it's not surprising to us at all that, folks like yourself, the owner operators that start to build visibility in the, DSO space or whatever the case might be, start getting a lot of inbound interest about transaction activity. So there's investment banks, brokers that reach out. And even those investment banks and brokers may have different kind of motivations for why they're reaching out. There's some groups that are buy-side agents. So they have a buyer client that has an interest in a specific parameter or geography, and they're doing a search on their behalf to try to identify acquisition opportunities for that potential acquirer. And so we always encourage our, people we speak with to, first discern, where that person who's reaching out, what their kind of motivations are for doing so. Is it to, again, tee up clients for their buy side, arrangements, or on the flip side, kind of similar to what we do, there's a number of groups that are sell side advisors. So they're seeking to understand when the right time for the company is to pursue a transaction and hopefully be under consideration as a group to be utilized as they go about that process. And I think lastly, and a lot of times, especially for our clients that aren't necessarily familiar with PE versus VC versus investment bankers, because the transaction marketplace is so competitive these days, private equity firms have business development initiatives of their own. There's, the strategic consolidators who are hiring business development individuals to make outreach directly to potential acquisition candidates to get ahead of that process in many instances. And so they may also be seeing outreach from those individuals who want to get in front of that prospect before anybody else does. And so the way that we consider things is that there's a huge ecosystem, right, of private equity firms, of investment banks, and all the rest. But I think common questions that we encourage people to ask are, what's the nature, if it's an investment bank, what's the nature of your services? Is it buy side? Is it sell side? Do you do both? Are there conflicts of interest potentially that you're, on the sell side representing dental clients, but on the buy side representing those same acquirers that might be part of a sell side process. It's good to iron that out. I think it's also important to understand what the capabilities of an investment bank are. How large is the team? What's their experience within the space? What does their process look like? Because certainly there's groups that focus on, representing clients that have, call it just $1 million to maybe 4 or 5 million of revenue. There's groups that specialize in representing companies that have 5 to 20 million, 20 million to 100 million, 100 million to 500 million. And so it's important to align that kind of expertise and relationships they bring to the table. And lastly, I think some of it is also kind of personality driven in nature. Business is built on relationships, and it's important to see who you could, work with and spend time with,
Sure.
Going through this very important process. So there's a number of different factors to consider, but we always encourage, especially when considering potential advisors, what's the experience, what's their buy side versus sell side, allegiance, what size deal do they typically focus on, and essentially from a personality standpoint, do you see yourself working well with that person through this process, which can be anywhere from, call it 6 months on the shortest end to upwards of a year if it's a complicated process.
Okay.
Yeah.
You're going to spend a little time. You got to make sure that you can get along with the people you're going to be working with. So let's talk about from a company side. What are the most common reasons that a company considers a transaction like this? And maybe AJ, you take it, and then Dave, I would love to hear on your side. What are the reasons that there's so many dental offices who are moving into the private equity space? Just kind of the pros and cons from that side of the table too. AJ, why don't you take it first?
Sure. So the common reasons we tend to see for groups to consider a transaction, I mentioned this a little bit off the top, but it tends to fall into 2 broad categories. One is based on the shareholders' motivations for the business. And we see this to be very different group by group. In certain instances, there's, at the simplest base, like an ownership transition that is facilitating the need for a transaction. There's, we've worked with clients that they're 65 to 70 years old, they're getting ready for retirement. They realize that a lot of their personal net worth is tied up in this business, and they want to unlock that, get some personal liquidity, and move on to something else. And so that ownership transition tends to be a big reason. We also see dynamics where it's kind of a shareholder risk, analysis where people see where healthcare broadly is going. They realize that size and scale is important to, success in, the changing environment. And so they may feel that personally, they're not ready to put the bill in terms of decreasing, let's say, their distributions from the business to reinvest for that, go forward future. And so instead of personally putting that bill, they're considering bringing in a partner who can mitigate some of their risk and allow the business to get where it needs to be in order to be successful in the long term. And a lot of times these businesses, they're successful in their own right. They don't necessarily need to do something, but from a business perspective, there could be acquisitions they'd like to do that they simply don't have the resources to take on. There may be a desire to partner with someone who has done this before multiple times and can provide some strategic resources. And there could be just, competitive concerns in a market. Let's say, it's a very, tightly bound geographic area. There's 2 competitors that recently went through private equity transactions. You're all competing for the same patients and, acquisition opportunities. It might make sense to bring in, more resources behind you to continue going head to head with those others. So those tend to be kind of, major reasons we see from a business perspective and a shareholder perspective. I think at the end of the day, money talks as well. And the valuation environment today has been, on par with the highest we've ever seen. And so in a lot of cases, we've talked to people who say, there's always a number that gets me to do it. And sometimes the number, even if it's, the timing is a little bit different than what they expected, is just compelling enough from an economic reason to do a transaction today.
Interesting.
Yeah.
Dave, what are you seeing?
Yeah, that's helpful. I mean, I think, and I'm just one dentist, among many, but I think, in the circles that I run in, I feel like a lot of dentists these days, the times where there was one doctor in one office, those are kind of the old days, the golden age of dentistry. And I think most young guys coming out now, they envision themselves not working in one office, but at least having ownership equity in multiple offices, working in large groups. And, one of the things that we've seen as we started to grow was, doing it the old fashioned way, air quotes, is that banks, they follow a very different protocol as far as lending. And there's a lot of personal guarantees that the owners are put on. And so as they expand and as they grow, those personal guarantees start to really rack up. And I think some of the more entrepreneurial dentists and owners, start to understand that is real liability. Something like COVID happens, or any kind of downturn in the economy, they leave themselves quite exposed. So I think that's another thing, is that the ability to expand, the speed with which you can expand, is something that at least our group has thought a lot about. Is instead of having to go and getting financing on every single new acquisition with the bank, and all of the onerous, bureaucracy that is involved in that, not the least of which are those personal guarantees, bringing on a strategic partner, particularly a financial partner, allows that process to work with a lot less friction. It just kind of greases the wheels, and it allows, good groups that have a scalable system in place. It allows them to get those acquisitions and do it much faster, much easier, simpler. So
in addition to the ability to exit the business at some point, which I think is a challenge just in business in general. So it's nice to see that's changing. But in addition to that, there's, those growth oriented, maybe younger dentists, because that was part of it. I had noticed that just people we talk to are younger and still considering bringing on equity. And it sounds like that has a lot to do with it.
Yeah, I think, they're, and AJ can probably speak to this, by what they see in the market, but there really are a couple different types of transactions. There's some where the owner, they're done. They're older, they're ready to retire, and they're ready for the beach money. So they realize that the money, the multiples that are getting paid right now are higher. And so they're saying, hey, I'm ready to go retire on the beach and I want to exit this. And these transactions allow them to go do that. Typically, there will be some work back. The private equity company wants them to stay on for a certain amount of time, usually. That's helpful for all parties. But I think more and more what we're seeing is young entrepreneurial dentists and owners really saying, hey, I want to keep working for 5, 10, 15 years. But it frees them up to really focus on scaling the business and kind of turning over some of the finances and some of those other administrative duties to a strategic partner or a private equity firm that comes and brings resources to them.
Yeah, I completely agree with what Dave said. And it's funny, sometimes we work with provider businesses, especially in the physician side, where one practice may have 30 different shareholders. And what we tend to see when they evaluate a transaction is exactly Dave's point. There's a cohort of 60 to 70-year-olds that, they're very eager to do something to cash out. We tend to see a grouping of younger entrepreneurial providers that, love the opportunity to grow and kind of make a name for themselves in the industry. And have the added benefit of taking some chips off the table and maybe paying off like their dental school, medical school debts, create a nest egg and position themselves well for the future. What tends to happen, and it's interesting, is that kind of the middle cohort, like the people who are call it in their 50s or so, late 40s to 50s, they're always thinking about, well, I'm not quite at the time of retirement, but I'm also not going to be here for 30 years like my younger counterparts. How does this work for me long term? But I think to Dave's point about the different types of deals that are out there, what we're seeing across private equity is the desire for kind of a partnership approach at the end of the day, especially for these larger businesses where when the private equity firm and the company that they're investing into succeeds, it creates a nice outcome for everybody involved from a shareholder perspective. And so for especially those younger career partners, they could see their shares in the business that they keep growing, 3, 4, 5 times their initial value. And ultimately, when the private equity firm and the DSO in this case sells to a larger PE fund, that could be a second transaction event where they take more liquidity out of the business. And with so many of these deals transacting private equity to private equity, there often is kind of an annuity event where every, call it 5 to 10 years or so, those younger partners can keep taking money out of the business as they sell their shares. And I think especially for those mid-career partners, it tends to be some of what Dave mentioned, which is around, risk mitigation. Do we still want to be the ones, putting our names on the bank documents, personally guaranteeing every single time? Do we have confidence in where healthcare is going? As well as, do we feel like our competitive position could actually put us ahead of everybody else by, let's say, doing a transaction today? So there's definitely multifaceted elements for all age groups to consider as they consider something like this.
So that's probably a good transition into deal structure. Let's talk a little bit about how deals are normally structured just in general. How are they normally structured?
Yeah, so there's a couple different structures that are common in the market today. I'd say, most often for the situation where, it's a single owner, they're looking to exit the business, there's typically a 100% buyout option available where especially groups that are backed by private equity or public in some cases have the wherewithal to acquire 100% of the stock of the business and allow the shareholders to exit completely. That probably has been the most common transaction structure for, let's say like the last, 15 or 20 years, especially leading up to like the boom of private equity that we're seeing today. For larger organizations, especially ones that are, led by management teams that have a view towards growth in the future, they may want to be the platform for consolidating a given geography. There's typically a majority acquisition element available to them where either private equity firms who are looking for their first entree into the dental space, as an example, would acquire 60 to 80% of a business. And the existing shareholders of that business would retain, call it 20 to 40% of value in stock of that entity going forward. And so I would say that comprises probably the most significant number of deals across like larger businesses that have, 2-3 million of EBITDA and up in healthcare services today, especially in situations where there's multiple providers that are also shareholders in the business. The private equity firm understands that the assets are the people in a provider-based business, and they want to ensure that people aren't just getting a huge check and walking away day one, because then, what did they just buy? It's an empty office with a bunch of chairs and patients that can't be seen. So there's an element that, retained equity, rollover equity, you may also hear it called, is a way to align interests between the private equity sponsor and the providers or the shareholder group going forward. And this can also be groups that are backed by private equity. So we call them strategics or PE-backed strategics. They can also use that type of majority approach. What we see maybe fewer times in the market is what's called a minority recapitalization. And so that's when a private equity firm will acquire, up to probably 49% of the equity in the business. And so there's a fewer number of PE funds that have the mandate that allow them to do minority transactions, which is why you see fewer of them in the market today. Also, groups that have already taken on private equity, like DSOs that have PE backing, they typically can't make minority acquisitions because, they don't necessarily, they can't necessarily take advantage of synergies in that case. And lastly, one of the things, one of the reasons why people may gravitate towards a minority deal is that there's kind of the sense that as a majority owner, you have, majority rights in terms of governance and how to run your business going forward. But because a lot of these private businesses are, the stock isn't tradable on the open market or anything like that. The sponsors who are investing into a minority position still have certain rights over how you grow the business, how you deploy capital, how financial performance is measured and tracked, as an example, that almost kind of mimic a situation where it's a majority transaction to begin with. And so some of the control that people perceive in a minority transaction may not necessarily be the case. And sometimes there's also a slight discount applied to a minority acquisition because there's a premium for investors that they pay in order to have kind of full kind of economic control of the business in a majority perspective. But that said, there's good reasons for why people go through minority deals. It might be a stepping stone to a larger transaction event down the road, and they can stomach some of the governance rights, et cetera. But it's typically a mix of these 100% buyouts, majority recapitalizations where it's a 60 to 80% acquisition, and minority transactions where up to 49% of equity is purchased. And a lot of it depends on, again, the shareholder motivations, what the capabilities of the buyer are, and just the position of the business today. And so certainly a lot of nuances, but hopefully that summarizes kind of the three key structures we see. And Dave, maybe you have some other thoughts that you see in the market.
Yeah, well, that's really helpful. I was actually just going to ask, like, when an owner comes to Provident and comes to you guys to be the investment banker, are those things kind of hashed out before you try to go to market or run a public process? Or, some of those terms people may not be as familiar with, but essentially before you put that business up for sale, is it really the owner and the investment banker that's really setting the tone for, hey, this is what the owner's looking for? Or is that kind of discovered, once you go to market, you kind of see what's out there and you kind of figure it out as you go?
Great question. In the beginning, we always like to understand what the shareholders' motivations are. If the desire, let's say it's an older shareholder that's 100% owner, their desire is to exit, probably doesn't make sense to kind of show them minority options, right? Because it just doesn't accomplish what they're looking for. But in a lot of cases, a lot of our clients, they qualify for, either of those three structures. And we kind of walk them through the pros and cons of each to begin with. But we encourage them to keep an open mind as far as what options might exist out there. And so usually what happens in our process is we're introducing a number of different partners that could take a viewpoint on where they could add the most value, whether that be through 100% acquisition, majority acquisition, or a minority. And we encourage everybody to bid off of kind of the same set of information, right? But kind of put their best foot forward on where they can add value. And we encourage our clients, when we have the offers in hand, we get the economics roughly similar from like a multiple of EBITDA standpoint, et cetera, to really just interact with each group, understand what their goals and visions are for the company, understanding if that meshes with their culture and their go forward expectations. And so at the end of the day, it becomes more of like a personality and strategy check as far as, is it best for the group from a strategic standpoint, from an economic perspective, to pick that 100% deal, that majority deal, or that minority deal at the end of the day. And for us, we just want to put the best options in front of them that could help achieve their goals. And so oftentimes, we're, going into a process thinking it might be, let's say, a 100% buyout, which again is a little bit more rare these days, just depending on the sector. And it ends up being a majority recap because that's what was best for the shareholders, given the partnership options available to them, and vice versa. So we try to not prescribe any kind of one particular thing if the company qualifies for all three options. But in some cases, just given the company, the size, the industry, the shareholder motivations, there may only be kind of one of those options in play at the end of the day.
Hey, sorry for the interruption. Just wanted to let you know that you can take the F3 assessment right now over at moneyinsights.net. And after the short 5-minute assessment, you'll get specific recommendations that will help you move from high income to high net worth. Enjoy the rest of the show.
Yeah, that's helpful. AJ, I kind of am chuckling in my mind. I hear this a lot where PE or investment bankers will say something like, we'll present to a couple different potential buyers. And in my mind, as an owner operator, I'm always thinking like, so where do these people come from that they're coming up with? And is there a carnival where you essentially all investment bankers would go, and really it doesn't necessarily matter which private or which investment banker you're using. Everybody kind of goes to the directory or the list of companies that are looking for. I mean, maybe you could speak a little bit to, I just wonder like what that means. I feel sometimes like there's a wizard behind the curtain, and the owner operators don't know. They're just referred to as potential buyers. Where are they found? How are they sourced? And are all investment bankers really going to that same list? Or speak to that, I guess.
Yeah, that's a great question. I think so. The short answer is no. There isn't one list that everybody goes to, and that's some of the secret sauce that goes into what we do on a daily basis. Kind of goes to the points I mentioned off the top. Like, does this investment bank spend most of their time in healthcare? How much work have they done in your sector? What size do they focus on? Because at the end of the day, private equity has been so successful in the returns they've been able to generate over the past, 20 years, that there's a huge proliferation of the number of funds, where they're getting their capital from, and their requisite experience. And so for us, we've been in operation for, 24 plus years now. So we have relationships that go back that far, that are specific to healthcare, a lot of times specific to industries as well. But it's kind of a number of different functions in terms of how we interact with those groups. Certainly, there's just longstanding relationships that we've had from 20 plus years ago. But what tends to happen in private equity is like a principal, let's say, or a vice president that's become very successful at private equity group ABC. They go out and decide to start their own fund. And so it's keeping the relationship with those people as they start new funds, understanding where their investment theses are, et cetera. There's also just new funds that are coming up every day. And so it's a matter of, researching those, understanding what parameters they're looking to invest in, what areas of healthcare they're interested in. And, the finding process goes on and on and on. But really, of the thousands of PE firms that invest in businesses today, our goal for each process that we go through is kind of fine tuning our understanding of where each group is spending most of their time and fitting that to the profile of our client. So there's certain PE funds that will come up repeatedly just because, their focus aligns very closely with ours. They may invest all of their fund in healthcare services, or like 75% of it. And it tends to be in the size range that we represent, which is, EBITDA anywhere from 2 or 3 million on the lower end to, 25 million on the higher end. But it becomes just kind of a constant curating exercise. And what we encourage for our clients who are thinking about hiring an investment bank is just making sure that, where their relationships lie and their understanding of those private equity firms' interests can really add value through a process. Because, what we feel is if you bring the most qualified groups to the table who have an understanding of dental in this case, who focus on this EBITDA profile, who have missed out, let's say, from our market intelligence on the last 3 deals that came to market, that's your best chance of finding a partner that is most likely to align with your business and pay the highest valuation. Whereas if you're kind of printing out a sheet of 1,000 groups and hoping something sticks, that's not necessarily the best use of our clients' confidential information, one. And two, you're not really kind of spending the time on the groups who ultimately will have the best view of your business. And so I think, especially from a PE standpoint, that's where most of the variability comes into play. Those groups who are backed by private equity and making acquisitions, I mean, everybody knows who those are. But even on top of that, it matters very closely into what the investment bank's experience was with those buyers, how they play in the acquisition process, what geographies they're interested in, and what the investment bank can do to leverage that interest to our clients' benefit at the end of the day.
Yeah, that's interesting. And you mentioned focusing on getting the highest valuation. So maybe that's a good transition into the valuation conversation. So talk a little bit about how you guys go about, creating a valuation for a business.
Happy to. So in healthcare services, valuations are typically arrived at as a multiple of EBITDA. So EBITDA
You better define that for everybody.
Yes, absolutely. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And we go a step further to, what the accounting definition of EBITDA is, to also adjust for non-recurring or discretionary expenses. So especially for owner-operated businesses, people may, have family members on payroll that don't really do anything on a day-to-day basis for tax reasons, as an example. There might be non-recurring expenses with respect to, let's say, like systems conversions or big legal fees that are added back. And there's also kind of one step further is, you can look at EBITDA across a number of different time periods, but it's important to consider what is baked into the growth of the business, but not yet captured in the last trailing 12 months, as an example. And this is where some of like the art versus just accounting science comes into play. So for instance, during COVID, a lot of groups had significant disruption to, their revenues and earnings. And so we had to look back and see, had COVID not happened, what theoretically would the earnings of the business have been? And similarly, if there's certain embedded growth, opportunities in the business that haven't fully materialized in the last 12 months, let's say, in November of last year, the company was able to negotiate a big increase in their payer contracts. That didn't show up in the numbers for January through October, but November and December it may have. So kind of thinking about what that might look like over a steady state 12-month basis. And there's a whole bunch of other things that could go into pro formas as well. But that's the EBITDA piece. And so, what the investment banker or any acquirer does is arrive at what they believe to be a defensible EBITDA number is. And then there's the multiple side of things, which it depends on a number of different factors, size, risk. It's essentially a function of risk, right? So the larger the company, the more growth opportunities it has, the sector that it plays in, the management team even can factor into that. That all contributes to the multiple itself. And so you take, the EBITDA basis that someone's willing to underwrite, the multiple that they're willing to pay for it, and that gives you your overall enterprise value equation. That's the most kind of common thing we see. Certainly there's a number of other approaches we see, like smaller transactions might be valued as, like based on a revenue basis. In, growing segments like the Medicare Advantage population for primary care and risk-based contracting, those can be like per patient, like valuation counts. In software, sometimes we see it based on like a revenue multiple standpoint. But most often, like 85% of what we see, especially in dental and other provider-based businesses, is an EBITDA-based valuation.
Okay. So when does it make sense for a potential owner to start considering the idea of private equity? I know you mentioned that you guys are normally like, $2-3 million on the low end, but just maybe hit on that. When during, from a timing perspective, what makes sense?
Yeah, it's a great question. It's so different group by group. But what we think is important, especially in sectors that are quickly consolidating, like dental as an example, is just being educated as much as possible off the bat. I think it's difficult when the group decides to do a transaction, but you're kind of starting from scratch in terms of understanding where to go or what to do. So, just understanding like why private equity is investing in the dental space, what advisors you should be kind of keeping in mind to go through a process like this. Those advisors probably also help you understand the right time to do something as well. So that's maybe a shameless plug, but something that we encourage as well. But there's also a lot of preparation steps that are important to consider when you think about a transaction. You think about, from a financial and accounting standpoint, making sure that, you can produce your financial statements on a monthly basis. Could you convert them to accrual basis financials, as an example? From a legal standpoint, are there any, structuring considerations you should be keeping in mind if you have, let's say, a C corp? That might limit some of your options if you want to do an asset deal versus a stock deal, as an example. And I think also maybe something that's a little bit forgotten, but we think is important at the end of the day, is from like a wealth management standpoint. So having someone who could help you take those proceeds you get and have that money work for you going forward is all very important. So, it's just going to be different company by company. I think if someone is dead set on becoming a private equity platform in their own right, there's certain, things we tell them to consider. So for instance, what we see in dental especially is that private equity interest starts building as a platform perspective. When you have, call it 3-4 million of EBITDA and up, it's important to have like a management team and platform infrastructure in place. So we kind of encourage groups to think about that before they're fully ready to kind of harness PE interest. From a strategic standpoint, there's interest across the board, but it's so situationally dependent that we feel that it's important to encourage individuals thinking about doing a transaction just to have some of these preliminary conversations and get their team in order, such that when the timing is right, you can hit the ground running and not necessarily run into any hiccups.
Good stuff. Okay, so this may be an obvious question, but maybe just something that's been on my mind. Why is there so much private equity moving to? So now we're talking about from the investor side. Again, it might just be that that's where the money is, but talk a little bit about why there's so much private equity moving into this, the physician, medical, dental space.
Yeah, I think there's a couple different factors. And investors always think about probably macro first. So healthcare across the board, growing need for services, the, population dynamic is skewing towards, the aging side who needs more services than ever. There's also, I think, a sense that certain subsectors of healthcare services, especially those that cater to like a consumer-based, healthcare delivery system, one that is efficient and saves the entire system dollars at the end of the day, as well as those that can provide access to care in areas that are otherwise difficult for individuals to obtain. Those tend to be, high priority areas for investors, knowing that there's just nascent demand for those services and there are a lot of tailwinds supporting that. I think as well, what's interesting to PE sponsors in the provider-based space is that they're tremendously fragmented markets. So I think in the DSO space, Dave, you might know better. It's like only 10% of overall dentists are affiliated with the DSO, something like that at this point. And that's not even considering private equity-backed DSOs. It's just DSOs in general. So there's a huge kind of runway for consolidation. And with consolidation comes the ability to leverage synergies, whether that's from a cost perspective, from a recruiting standpoint, from just like a number of different factors that come into play. And so, keeping that in mind, growth opportunities, fragmentation, a desire for especially sellers to participate in kind of a scaled model at the end of the day, it's being undergirded by some favorable like debt market trends, for instance. Interest rates are really low. You can tap into debt as a cheap tool for financing to build these businesses and grow. And I think just underscoring everything is that PE funds have been creating pretty exceptional returns in the overall perspective of fund managers. And so you see wealthy individuals, you see school endowments, you're seeing institutions like insurance companies allocate more and more of their investments towards private equity in nature. And so there's just, a lot of momentum just from a demand perspective from investors to offset what you might see as potential volatility, especially in like the market today. If you know that PE funds are going to return 3 to 5 times, but you see the stock market doing a whipsaw every day, probably more people are going into private equity as a safer alternative. Even though it's not safer necessarily, there's more risk certainly. It's just the return profile and the background of it is easier to kind of comprehend versus the day-to-day fluctuations of the stock market.
And with that shift, have you seen any movement in terms of the valuation, like the multiples, that kind of thing?
There certainly has been, because it's like a supply-demand imbalance sort of thing, right?
Yep.
There's, I'd say overall valuations have continued to increase. And if you were to talk to us like 2 years ago, we'd say, oh, valuations are at the top. We don't think that they can go any higher. And then we hear about, deals going for 17 times EBITDA. And we're like, well, we didn't think that was possible if you asked us that 2 years ago. I think we're also starting to see that on a local level as well, just because, there's areas like dental where there's 80 to 100 some odd PE-backed groups. They're all fighting over probably a similar number of acquisition opportunities. So even those smaller assets have been valued higher than where they were before. But certainly from a platform standpoint, the largest groups out there, especially those who have, pretty significant opportunity going forward, they've still been able to carry some pretty significant valuations. What I will say, though, is that people are very mindful of doing this in a sustainable manner today. So while the valuations have been as high as they were, I think what we're seeing from private equity firms is that their level of due diligence has also increased significantly than where it was a few years ago, because they're mindful of, putting hundreds of millions of dollars behind an endeavor that may fall apart because they didn't do all their homework ahead of time. That's kind of the market death, if you will, for fund managers if they're not able to create good returns for their investors. So I think kind of goes to making sure you're prepared for a process like this. There's a pretty significant level of due diligence that goes on. So it's important to know kind of your business inside and out before you start this process.
Yeah, that makes sense. So we have a lot of medical and dental practitioners in our client base and our listeners. Where's like the starting point? So let's say someone's considering a transaction. What's the starting point? Where do they go? Again, they've heard a podcast like this. Maybe they've done a little bit of due diligence and research about it conceptually. What's the starting point for someone to kind of get involved and start really considering whether doing a deal like this could make sense for them?
Absolutely. I think a good first step is certainly to talk to an advisor, whether that be someone like us from an investment banking standpoint, if they've heard about us or their friends have worked with us or heard our podcast, whatever the case might be. Again, maybe somewhat of a shameless plug. But I think also groups that maybe have like a trusted legal advisor that's helped them through like corporate formation, other kind of corporate needs, that have worked with investment bankers or have some perspectives of their own if they're M&A attorneys on what these deals look like and the best way to become prepared for that. Similarly, from an accounting standpoint, a lot of groups might lean on an external CPA that has been through these types of transactions before and can help them think through from an accounting standpoint or just from a preparedness standpoint what the best steps may be. So I think at the end of the day, it's just seeking out someone that has experience in this space, whether that's in the existing Rolodex of contacts that they have or speaking with someone maybe a little bit outside of that comes in through their own research. I think what's also interesting today is that so many transactions have happened that it's almost like an entrepreneur to entrepreneur type discussion where they may talk to an acquaintance of theirs or a friend that has gone through this process and understanding, what would they have done differently had they known what they know today. So I think we'd encourage just tapping into any network you have or seeking that out if possible to get this process started, because it's a really complex one and one that you want to make sure goes right. So it's important to talk to as many educated people about it as possible.
Yeah, that makes sense. I just think about as a business owner how difficult it could be to give up control of a business potentially, right? So if you're going to do something like that, it has to be done right. So that makes a lot of sense. Okay, what are potential pitfalls? What are the potential pitfalls for people considering, and maybe Dave, you've probably looked into these things too, but just maybe both of you talk a little bit about some of the potential issues or maybe the downsides of doing a transaction like this.
I think for me, I think people, and AJ kind of spoke to it just now in his answer. So I don't want to be redundant, but I think, knowledge is power. And, ultimately, I think one of the biggest mistakes I think anybody could make, our group has gone through this, a process. I won't say the process because there's a number of different ways that people transact, but we've been approached a couple different times. We've had a couple formal offers, and I look back, a few years ago when we had received some of these formal offers, and I almost blush at what I didn't know. And sometimes you don't know what you don't know. And I think a lot of times these groups, I don't want to say that they're doing it intentionally or that they're doing anything with malfeasance in mind. I mean, they're just doing good business. It's America, and I love that about America. But I do think that without knowing and understanding all the different types of options and deal structures, and whether you're going with a strategic partner, whether you're going with a capital partner, whether you're going to be the platform yourself, what those deals mean after the first transaction, going into a possible second transaction, and even a third. There's so many intricacies that, when we think about it, guys like AJ and these private equity firms, these are some of the smartest people that are around in the country. I mean, they know and they understand things. So to think that a doc who's just, been sitting in some science classes and either working with patients or filling teeth in my case, or straightening teeth in my case, to think that we would understand very much after just a couple of days of talking to people, I think it really minimizes how much information there really is in this space. And so, maybe in AJ's answer, he could just speak to, it's difficult because it's hard in a podcast like this to get that kind of a background. And there also doesn't seem to be a repository where it's like, go to YouTube and learn, from A to Z, all the different deal structures. And so, it's one of those things that you don't know what you don't know. And so I think the more questions you ask, the more podcasts you listen to, the more research that you do and the books that you read, at least in our own situation, we've learned so much, and we still haven't gone through a transaction. And I'm sure even going through it, we would learn, a ton more. So that's just some random thoughts.
Yeah, that's helpful.
Yeah, I think that's really, important what Dave just mentioned, just kind of minimizing some of the information asymmetry that exists, because if you deal with the buyer directly, they know a lot more oftentimes about the overall process than you do. So just making sure that there's a level playing ground one way or the other. I think as well, where we see some pitfalls are when, especially you have different motivations among, let's say, a shareholder group or a management team that haven't been quite fully addressed before you go through a process like this. If sometimes we see scenarios where there's one kind of CEO figure or lead partner that essentially goes down this process and then figures they can pitch it to their minority partners at the finish line and hope everything's okay, without necessarily creating that level of transparency among the people who need to be in the know to ask their questions, have the knowledge, as Dave mentioned. So setting kind of expectations around why the shareholder group wants to do this. Does it make sense to explore it as a group and at least see what's out there versus, let's say, creating, misalignment of information for the people that need to be in the know. That tends to be a big reason why deals may stumble. And I think, certainly there's a number of other nuances that go into it. Like, for instance, an accounting standpoint, that's probably the area where we see most lower middle market deals fall apart because they're not audited financials in most cases. Oftentimes it might be someone who's wearing the hat of COO and bookkeeper and, front desk person, and just maybe that's a stretch, that's doing the books at the same time. So, there's a lot of things that we encourage from a financial perspective, just to ensure that things will go smoothly through a process like this. But I think it's ultimately having kind of a good alignment of expectations and motivations, because personalities have a lot more to do with how transactions happen, especially in this kind of landscape that we're talking about, compared to, let's say, the big PE-backed groups where a decision's really made just on financial returns. For, a founder-owned business, it's very personal, and there's legacy involved and things like that. So just having everybody working in the same direction and on the same timeline is important.
Like it. Okay. This has been super informative, AJ. What did we miss? Is there anything in this kind of world that we've been talking about that we should have talked about and didn't, or did we cover it?
No, I think you guys asked a lot of really good questions and hit the hard topics that we often address with our clients when they're going through similar exploration conversations like these. We could probably go down a rabbit hole for hours and hours of other questions, I'm sure, but nothing else comes to mind from
Okay, well,
my
at
side.
least we have a good high-level overview then, it sounds like. And how can our listeners get connected with you? How can they get in contact with you? What's the best way?
Yeah, happy to share my email address, my phone number as a good way to get in touch with us at Provident.
Please.
My email is ashekar@providenthp.com. And you can also go to our website, providenthp.com, and you can find our contact information there as well.
Awesome. Okay, so providenthp.com. You can also reach out to Rod and I, and we are happy to pass along information to AJ. Okay, well, I think we covered it then. Dave, thanks for being a guest host. It was helpful to have an insider perspective. We super appreciate it. And AJ, it was really great to have you on. Thanks for all of the information. I'm certain that we'll have some people who are wanting to get in contact with you. So we appreciate you coming on with us.
Yeah, thank you so much for the opportunity. Really enjoyed the opportunity to speak with you, but with the three of you anyway, and looking forward to hopefully doing something again in the near term.
Awesome. That sounds great. Thanks, guys.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.